Today on Retiring Well with Centennial Wealth Advisory, we are examining the question, are we at the beginning of a bear market? Will this year be another 2008, or are we just experiencing a blip on the radar? What are the signs to watch for?
These are very common when we're about to see a turnaround and see it go into bear territory. Now remember, a bear market is defined as 20% loss over a market cycle.
And coming up, we'll talk about how a potential bear market could affect your retirement savings. What can you do to protect your retirement savings while still taking advantage of growth opportunities?
Financial success comes from investing in such a way so you protect what you've worked so hard to build. So when the down markets come, you're protected. You want to protect yourself from losing a lot of money. But at the same time, you still want to grow your portfolio. You still want to grow.
All this and more on Retiring Well with Centennial Wealth Advisory, starting right now.
Retiring Well with Centennial Wealth Advisory, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Centennial Wealth Advisory, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and I got to tell you, I'm really looking forward to this week's show. This week, we are asking the question, are we now in a bear market? Or is this just another blip on the radar screen? Now, please keep in mind, we are recording this towards the end of January. In fact, I think it's February the 1st already. And so far, we've seen a really ugly start to the year. Well, are we on our way down? Is 2016 going to be the big down year? Is it going to be another 2008? Or is this just another blip as the markets continue their march upwards? That's what we're going to look at today. Now, before I do that, I want to just take a moment and share with you why we do this show. You see, I believe that retirees and those Americans who are nearing retirement, I believe Americans, as you're in retirement, nearing retirement, you just need to rethink how you manage your money. See, the reality is this. The financial media, the financial machine, if you will, which is really an outlet of Wall Street, it's all designed to have you thinking about growing your money and risking your money and all that kind of stuff. But the reality is this. Once you have built up your nest egg to a certain stage, once you reach the point of financial security, your job changes as an investor. No longer should you be focused on just growing your portfolio. Instead, financial success comes from investing in such a way so you protect what you've worked so hard to build. So when the down markets come, you're protected. You want to protect yourself from losing a lot of money. But at the same time, you still want to grow your portfolio. You still want to grow, but you have to be more careful than ever when markets go south to protect what you've built. Investing to create those types of outcomes, it's just different from what you watch on TV or what you read about, in the magazines. It's a different world, especially if you're trying to take income when all that is going on. So that's what we do on this show. Our job is to help you. Once you hit that stage of financial security, how do you protect what you've built? How do you still grow it? And how do you take income with all that going on? It's just a different ballgame. So with that in mind, let's go ahead and jump into today's topic. We're asking the question, are we at the beginning of a big bear market, a big bad bear? I mean, think about how your retirement savings would be affected if the markets are heading down like they did in 2008. Will 2016 be a duplicate of 2008? Well, I can promise you this, it won't be exactly the same. Bear markets are never, ever the same. I mean, think about in 2008, it dropped really fast. What about the dot-com crash? Remember that? 2000, 2001, 2002? That was 3 years of just steady downward pressure on markets. Unless you were in a dot-com and then you got crushed. The point is they're always different. They're never the same. Today what we're going to do is we're going to look at a case for the bear market and a case for the continued bull. In other words, we're going to look at what's going on out there, and we're going to say, well, here are reasons to think that we're at the beginning of a bear market. Here are the reasons that we think markets are going to go south. Then we're going to turn that around, and we're going to say, well, here are the reasons that a bull market still has room to run. So we're going to look at both sides of that coin. At the end of the day, I don't know what's going to happen. No one knows where markets are going to go. We just don't know. We can only make our best guess. But this is the message that I want you to take to heart. If you're sitting there, you're just sitting on your couch today in your favorite chair watching me, if you're worried about which way markets are going, if you think it's going to affect your retirement planning, then I would respectfully submit to you that your money's not structured in the right way already. You already got a problem because the direction of the markets just shouldn't matter. Don't go anywhere. Coming up, we'll start with the case for the bear market.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
Did you know that we are currently in the second longest bull market in history? That's right. Since 2009, we have been roaring. Of course, we all know that what goes up must come down. And we all know that that bear is a-coming sometime in the future. Now, we don't know when, but it's probably not going to be too much longer. I have a very simple question for you. When the bear market comes, like it did in 2008 or in the early 2000s, how much of your hard-earned savings are you going to lose? Do you even know? I invite you to call us at 512-265-5000. Give us a call. We'll help you analyze your portfolio, tell you how much you would lose when markets go south. Again, 512-265-5000.
Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date and location that works best for you. Wednesday, April 13th or Thursday, April 14th at Texas Land and Cattle in Cedar Park, or Wednesday, May 25th or Thursday, May 26th at Gumbo's North in Georgetown. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
Welcome back. As I mentioned before the break, we were going to take this segment and talk about the case for a bear market coming here in the very near future. So I've got a little bit of information for you. Some of it's from last year, but this is the starting point. We are currently in the second longest bull market in history. I mean, we all know it's got to end at some point. They don't go forever. This has been going on a while. and there's absolutely no reason to think that it's got to stop soon. Looking at some of the returns, now this is also kind of important, talking about a little bit about some bear market signals. If you look at the last year, 2015, you might recall that the Dow, for example, it kept bumping up to 18,000 and then would drop, and then bump back up again and drop. It's very common when you're seen at the end of a bull market, when there are these numbers that the market just cannot seem to break and stay above. And with the Dow, it was 18,000, and it's hard to, when we look at that, it's pretty reasonable. I mean, the S&P was flat last year, the Dow was down a little bit, the NASDAQ was up a little bit, and that was kind of neat. But then look at the first couple weeks of January here at the bottom. I mean, S&P down, Dow down, the NASDAQ gave up all of its gains already last year. Basically what we've been seeing is we saw the bull market go up, 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 with some hiccups along the way, of course. But it's like it's hit its top and it just can't seem to get any higher. These are very common when we're about to see a turnaround and see it go into bear territory. Now remember, a bear market is defined as 20% loss over a market cycle. Now, if we also, this is the S&P in 2015. Look at how flat it is. I mean, it was very flat and then bang, it dropped. Remember back in August, how it just, the end of August, beginning of September, just tanked, went down, tried to climb back up again, but it's kind of level. And then since December 29, look what's happened. Bam, just a big drop. Now, again, is this the precursor to a bear market? Is this what we're seeing, where the markets have gone up, 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 and then they've kind of hit that point? And this happens a lot when we see the beginnings of a bear market, at the beginning stages. This happens all the time. Markets go up, they kind of hit a spot that they cannot get above, and then bang, they start dropping. And then you see a little bit of a rise, just like we saw here this fall, trying to make it back up, and then bang, drops again, like it did first part of this year. That's very common. We see this all the time at the beginnings of a bear market. So one could argue, given all the economic, how the people feel out there, that this is indeed the beginning stages. Even looking at some of the different asset classes, unless you were in European or NASDAQ, you were breaking even or losing money. I mean, look at this. Bonds last year, basically flat. High yield bonds, lost. And then look at this. If you were in commodities, energy, I mean, you know what's been happening to the price of oil. I mean, look at them. Everything lost money last year. Again, what we saw is the markets, part of the markets made money or were kind of flat, but there were a lot of sectors that lost money. And even a diversified portfolio lost 4% last year. That's about as diversified as it gets from a world perspective, and it even lost money. 4% down. That's the worst year in 15 years. Again, all of this stuff is very typical of what we see at the beginning of a bear market. And then, of course, we have the Oracle of Omaha. None other than Warren Buffett himself. How did he end up doing last year? Even Warren Buffett was down 12%. I mean, you're seeing, if even the best investor in the world is losing money, it's probably a sign that markets aren't doing so well. So, are we looking at the beginning of a bear market? We're seeing a lot of signals that would indicate that indeed we are seeing the beginning of the bear. Now, don't go anywhere, because pretty soon we'll look at the other side of the coin.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
Do you have a plan for how to generate income during retirement? Are you going to run out of money? In today's marketplace, retirees have concerns about the volatility of the market. People have concerns that the traditional balanced portfolio strategy that advisors used in the 80s and 90s isn't good enough in today's new normal economy. There are more secure options available for you today, and that's what we specialize in here at Centennial Wealth Advisory. If you don't yet have a plan or would like a second opinion on your retirement income plan, please call us today for a free, no obligation, complete retirement review.
Are you retired? Are you nearing retirement? And by nearing retirement, I mean 6 months away, a year away, maybe 5 years away? Well, if you are, then you really want to call the number on the screen. Give us a call, 512-265-5000. I want to invite you to come to our office and sit down and have a true fiduciary look at your retirement planning and make sure that you're set up the way you should be. Are your investments structured properly? What about your income planning? How about taxes? Taxes can really eat you alive if you're not careful. Come on in, let us take a look at your portfolio and help you make sure that you are making smart choices in all those areas: investments, income, and taxes. Just call the number on the screen, 512-265-5000. Again, that's 512-265-5000. All right, welcome back. In our last segment, we made the case for the bear market. Now, let's take a look at the case for a continued bull run. So we start off with this. This is really important. Whenever you look at markets, there are short-term drivers and there are long-term drivers. Short-term are things like fear, panic, greed, the emotions, if you will. Whereas the long-term drivers are more things like your economic direction, revenues, profits, cash flow, things that are more logic-induced. In other words, we often see markets do some crazy things in the short run, but the long-term impact is going to be more logical. So if we want to focus on the fundamentals, look at things like auto sales. They're the highest ever in 2015. Unemployment is bottoming. By the way, if any of you have had to try to hire someone like I've had to do recently, it's hard to get somebody who's good. I mean, good people, they are having no problems with unemployment. Consumer confidence, spending is up. Those are key drivers to the economy. And non-manufacturing data, very, very strong. So those are good signals. GDP, that's the gross domestic product. Is the economy growing? 30-year average is 2.7, of course, but since the recession, now this back since 2008, it's been 2.2, so it's been pretty close. Now, a recession is defined as 2 quarters in negative GDP. So 2 quarters where the economy is shrinking. Well, our first quarter was down less than 1%, but ever since then, it's been up. And again, these are positive things. This is kind of important because this just came out in middle of December. This is Janet Yellen with the Fed. And they raised interest rates, if you'll recall, and they're planning on continuing to raise rates. And this is what she said. And if anybody has the pulse in the economy, it's her. She said, "I feel confident about the fundamentals driving the U.S. economy, the health of U.S. households, and domestic spending," Fed Chief Janet Yellen said during a press conference. "There are pressures on some sectors of the economy, particularly manufacturing and energy, but the underlying health of the U.S. economy I consider to be quite sound." So she is saying that the economy is looking good. Generally speaking, you don't see a bear market coming when the economy's doing well. You normally see it when something in the economy is broken. You look at U.S. equity. How do the stock markets react historically after there's been an increase in interest rates? And if you look historically, a year after that increase, good things are happening to the markets, so that's a positive. And then, of course, we take a look at this. Since the market bottomed in 2009, we have had all kinds of these different events coming out. Every single vertical line there is an event that looked scary at the time. There was the H1N1 virus. Obama signed the Obamacare, the health care bill. We had Meredith Whitney predicting muni bond trouble. I mean, all this kind of stuff is happening. Yet it's called markets rising during the wall of worry, if you will. That's the phrase. Oftentimes when people are really concerned, markets do well, and that's, people are concerned today, so that's kind of a positive sign. And then market volatility, it's just part of the ride. I mean, it's very common. Look at how many times during this bull market that the markets have dropped 10% or more, but they've not dropped 20%. That's the bear market measurement. We've not seen it. And the question is, what about now? Is it going to drop more? We're seeing the drop. Is it going to drop to that 20% level? Are we officially going to go into a bear market? When all is said and done, there's one thing that bothers me about people that are saying that we're looking at a bear market. This is the one thing that bothers me. Where's all the irrational exuberance? At the end of every bull market, we see people, it's like everybody's buying. Everybody can't get in the markets fast enough. Where is the irrational exuberance? I don't see it. And if there's no irrational exuberance, then the odds of the bull market continuing are actually quite good.
Have you called us yet to meet with our team? Let us help you with your retirement planning. Today is a great day to take the first step. Call us now at 512-265-5000.
Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date and location that works best for you. Wednesday, April 13th or Thursday, April 14th at Texas Land and Cattle in Cedar Park, or Wednesday, May 25th or Thursday, May 26th at Gumbo's North in Georgetown. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 512-265-5000 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 512-265-5000 today.
In this episode of Math and Money, we are taking a look at potential outcomes. So here you have your retirement savings, and we want to take a look and see how well it might do if there's a bull market compared to how poorly it might do if there's a bear market. And that's what we've been talking about on the show today. Are we looking at a bear market? Will the bull continue to run? We don't know what's going to happen. Let's be honest, no one knows. But what we can do is we can look at potential outcomes. We can look at a portfolio and identify how much risk it has and what types of outcomes you might see. So what I've done on the board here is I've illustrated 2 portfolios. We will call them Portfolio A and Portfolio B. And when we look at these 2 portfolios, what we're identifying is how well or poorly they might do in different markets. So let's start over here with Portfolio A. We're going to assume that right here we're starting with $100,000. That's what we'll assume with. We'll pretend you have $100,000 here. And in Portfolio A, if there is a bull market, if there's a bull market, you have the potential in a single year for that $100,000 to grow up to 150,000. I know everybody would be pretty happy with that outcome, right? But what if there's a bear market? What if the market goes down this year? Well, this same portfolio has a potential to lose 50,000, go from 100 down to 50. Now, let's compare that to portfolio B as in boy. Same 100,000 that you're at right now. If there's a bull market, if things go well, you have the potential to go up to 120. So not as good as portfolio A. In other words, if the markets go up, portfolio A is going to make more money for you. But what if markets go down? What if there's a bear market? Well, here, instead of losing 50,000 like we did over here, we would only lose 10,000. Now, most people would probably say, hey, if markets go down, I'd rather lose 10 versus 50. That's kind of one of those no-brainers. The issue is, or the question is, which one are you? Would you rather give up some of that upside, maybe only earn 20 versus 50? Would you give up some of the upside to keep your losses to a minimum? Or are you the kind of person who says, no, I want all the upside and I'll accept the losses? Well, let's throw another log on the fire, as it were, another piece to the puzzle. What if both of these portfolios had an average return of about 6 to 7% a year? In other words, each year, if you looked at both of these portfolios over time, what if they both earned on average about 6,000 to 7,000 in a year? So on average, when you take the good years and the bad years and you average them out in portfolio A, you take the good years and the bad years in portfolio B and you average them out over time, say over 10 years, 15 years, 20 years, they both end up right here about 6 or 7% on the upside. Now, which portfolio do you like better? Are you willing to risk 50% of your money in order to get that 6 to 7% rate of return? Or what if you could only risk 10 to get the same return? You see, there's a reason I'm sharing this with you. It is surprising how many people just like you, when they come into our office to visit with us and we run a portfolio analysis for them, we learn that they think, people just like you think you're in portfolio B. But at the end of the day, when we put your portfolio in Morningstar, Morningstar tells us, no, you're not over here. You're actually over here. This is why it's so important that you sit down with us to have us analyze your portfolio. That, my friends, is math and money.